Everyone thinks this company is dying, but the numbers don't agree. Something feels off here. Big time. You've got over 30 billion in revenue. Not small, not struggling. Massive. Then 1.5 trillion in payments. Yeah, trillion. With a T. And still, the market treats it like it's done. Low valuation. No excitement. Almost ignored. That's the tension. That's the story. Because on one side, it's a machine. Cash flowing. Buying back shares. Scaling globally. And on the other, it's priced like yesterday's news. That gap shouldn't exist. But it does. And when gaps like this show up, something usually breaks. One way or another. What stands out to me is how extreme this mismatch is. It doesn't feel like normal mispricing. It feels like the market is betting on something going wrong. Now here's where it gets brutal. The story around this company? Not good. At all. Fading relic. That's the label. And honestly, I didn't expect it to be this bad. The stock dropped from over 300 to under 70. That's not a dip. That's a collapse. And the reasons sound convincing at first. Growth? Slowing hard. From over 20% down to single digits. Competition? Everywhere. Apple, Stripe, Block, all closing in. And then innovation. Just stalled. Completely. Suddenly, this tech leader looks old. But here's the thing. Narratives love extremes. They go from unstoppable to finished, with almost nothing in between. The way I see it, the market didn't just adjust expectations. It flipped the entire identity of the company. And that kind of shift, it usually overshoots. So what actually caused this shift? This is where it gets interesting. First, uses. Growth just stopped. Around 430 million accounts. That's a ceiling. A hard one. Then margins start getting messy. More volume coming from Braintree. Lower margin. Less profitable. So yay. Payments are flowing. But the quality of those payments, dropping. And then leadership uncertainty hits. New direction. New CEO. But no clear results yet. Put it all together, and you get the perfect storm. Slowing growth. Shrinking margins. Rising competition. It becomes easy to say, this company is done. But easy narratives are dangerous, because they ignore one thing. What happens next? This suggests something bigger to me. When everything lines up perfectly for a negative story, the market usually stops asking if things can improve. And that's where mistakes begin. And then something changed. Quietly. Almost ignored. Margins stopped falling. For a while, they dropped from 27 down to 20%. That's serious compression. But now, they're ticking back up. 22% and climbing. Not explosive, but directional. And direction matters more than speed. Because this isn't about growth anymore. It's about discipline. Less focus on chasing users. More focus on making each user valuable. That's a completely different game. And most people are still looking at the old one. That's the disconnect again. Because turnarounds don't look exciting at first. They look boring, slow, unnoticed, until suddenly they're obvious. What surprised me here is how early this shift feels. It's not fully visible yet, but the direction is clear, and markets are usually late to that kind of change. Now, look at this. Because this is where it gets uncomfortable now, let's zoom out for a second. Because this part, most people completely miss. 1.5 trillion in payment volume. Just pause on that. That's not a weak platform. That's infrastructure. Then revenue, over 30 billion. And free cash flow, more than 5 billion. Real cash, not accounting tricks. And here's where it gets weird again. Despite all this, the valuation stays low. Like the market doesn't believe it. Or worse, doesn't care. So what does management do? They start buying back shares. Aggressively. Reducing supply. Increasing ownership per share. Quietly compounding value. While everyone's distracted by the narrative. This is where it flips again. Because companies with this kind of cash flow don't usually stay ignored forever. The way I see it, this is the core of the entire story. A powerful financial engine operating under skepticism. And that combination doesn't stay stable for long. Table. Revenue, 1.41 billion. Up 70%. United States growth, 93%. Guidance, around 7.2 billion. growing over 60%. But here's the part that really stands out. Rule of 40? Gone. This is 127%. That's not normal. That's elite level efficiency. And yet, the stock isn't reacting the way you'd expect. Why? That's the real question. What this suggests to me is the market still doesn't fully trust these numbers yet. Here's the real pivot. And honestly, this changes everything. The old strategy? Chase users. At any cost. More accounts. More volume. Messy growth. But now, that's gone. Replaced with something sharper. Cost cuts. Billions in savings. Focus shifts completely. Not how many users, but how valuable they are. That's a big difference. And then the mix starts evolving. Braintree drives scale. Branded checkout improves margins. Two engines, different roles, working together. It's not about growth versus profit anymore. It's about optimizing both. And most people still think it's the old company. That's the opportunity, or the trap. What stands out to me is how deliberate this shift is. This isn't random improvement. It's a design transition toward efficiency, and those usually take time before they show up clearly. Now this part, almost no one talks about, because it's not flashy, but it's powerful. Revenue grows, maybe 8%. Nothing crazy. Margins slowly expand. And shares keep shrinking. That's the loop. Simple, but effective. And over time, it compounds. Earnings per share go up, not because of hype, but because of structure. And here's the blind spot. The market is obsessed with top-line growth. 20% or nothing. But that's outdated thinking. Because with $5 billion in free cash flow, you don't need hypergrowth. You need efficiency and consistency. This is where it flips again. Because slow, efficient growth can outperform fast, messy growth. The way I see it, this is a shift from story stocks to systems. And systems, when they work, tend to be underestimated for a long time. But let's not get carried away, because this can still go wrong. Easily. Competition isn't slowing down. Apple keeps expanding. Stripe keeps innovating. Pressure is constant. And margins? Still fragile. If branded checkout weakens again, profitability takes a hit. Then growth. If it drops below 5%, that's a problem. A real one. And innovation? If they fall behind again, the relic narrative sticks. Permanently. That's the risk. Not collapse, but stagnation. And stagnation kills multiples. So yeah, low valuation might be justified, if nothing improves. This suggests something important. The downside case isn't dramatic failure, it's slow disappointment. And those are harder to spot, but just as dangerous. Now flip it. Same company, same numbers, different outcome. Growth stabilizes. 8 to 10%. Margins expand. Back toward 25. Buybacks continue. Relentlessly. Suddenly, earnings per share climbs. $6, maybe $7. And then the market changes its mind. Not dramatically, just slightly. Valuation moves from low teens to mid-teens. That's it. But that small shift creates a big move because sentiment follows performance, not the other way around. And once that shift starts, it tends to accelerate, quietly at first, then all at once. What stands out to me is how realistic this scenario is. It doesn't require perfection, just consistent execution. And that's what makes it dangerous to ignore. This isn't the same company anymore. That's the part people miss. Old version, chasing growth, over 20%. Messy, bloated, too many products, not enough focus. Now, cleaner, leaner, more disciplined. Growth is lower, sure, but cash flow is stronger. And capital allocation, way more aggressive. Buybacks, efficiency, optimization. It's a different mindset, not a growth story anymore, a profitability story. And the market hasn't fully adjusted to that, still pricing it like the old version failed, not like the new version is forming. This is where it gets interesting again, because identity shifts take time to be recognized. The way I see it, this is the middle phase. Not broken, not fully fixed. And that's exactly where mispricing tends to live. Now step back. Look at the setup. Downside, anchored by cash flow. $5 billion plus. That's a strong base. Valuation already low. So, expectations? Not high. That limits the fall. But upside comes from execution. Margins improve. Earnings compound. Sentiment shifts. And suddenly, the same business gets re-rated. That's the asymmetry. Limited downside. Open-ended upside. But only if things go right. And that's the key tension. Because right now, the market doesn't believe it will. This suggests something subtle. The opportunity isn't in the numbers alone. It's in the gap between belief and reality. And that gap is still wide. So now the real question. When does the market notice? Not if. When? Because the roadmap is already there. Margins improving. Checkout stabilizing. Buybacks continuing. Step by step. Nothing explosive, but consistent. And that's the tricky part. Because the best setups don't look exciting early. They look ignored. Almost boring. Until one quarter, something clicks. Earnings surprise. Margins beat expectations. And sentiment shifts. Fast. That's when a move happens. Not before. And by then, it's already started. The way I see it, this is all about positioning before the narrative changes. Because once it does, the easy part is already gone.